Welcome to This Explainer. Okay, today we are unpacking something really fascinating. It's a highly complex, almost entirely invisible global mechanic that directly dictates your personal finances. We're talking about a massive force that literally moves markets, yet it operates completely behind the scenes.
Let me ask you something that probably hits a little close to home right now. Who really controls your mortgage rate? I mean, if you're looking to buy a house or maybe trying to refinance, you are undoubtedly feeling the acute pain of stubbornly high mortgage rates. Now, most people think the answer to this question is super obvious, but it actually points to a massive, hidden global mystery. Let's dive right into this because the plot twist here is just wild. Everybody obsesses over the Federal Reserve in Washington, right? We all decode Jerome Powell's every single word. But the real decision makers pulling the levers of your personal finances, they might actually just be anonymous institutional money managers sitting in a Tokyo office tower. To figure out how we got here, we actually have to jump in a time machine back to 1992. That's when Japan's massive asset bubble burst. Real estate and stocks absolutely collapsed, kicking off what they call the lost decades, basically 30 years of an economy completely stuck in neutral. To try and fix it, the Bank of Japan essentially put their interest rates in a medically induced coma. I mean, they took rates down to zero, then below zero, and finally enacted yield curve control just to permanently cap long-term rates.
Let's put a human face on this giant global machine. We'll call him John. He's a 50-something pension manager working in Japan. His job is brutally simple on paper: generate returns for millions of Japanese retirees. But wait, his own government's bonds pay exactly 0%. So John has a pretty massive problem. How on earth does he get a return when money at home makes absolutely nothing?
Well, his solution was literally a stroke of genius in its simplicity. It's known as the yen carry trade. Step 1, John borrows Japanese yen at essentially 0%. Step 2, he converts that yen into US dollars. Step 3, he buys US Treasury bonds paying, say, 4 or 5%. And step 4, he just pockets the difference. This invisible, incredibly simple force fueled cheap global borrowing for 3 entire decades.
But, there's always a catch. Picture not just John, but basically every single pension fund, life insurer, and hedge fund doing the exact same thing for 30 years. We are talking about an entire global arrangement worth trillions of dollars, all resting on one incredibly fragile assumption: that Japanese interest rates would just stay near zero forever.
So the multi-trillion-dollar question is, what happens when forever finally ends? Well, in 2024, Japan finally gets some inflation. Prices actually start rising, so their central bank has to act. By 2026, Japan's policy rate is projected to sit around 1%. Now, to an American, 1% probably sounds adorable, but for Japan, that is a 30-year high. It's quite literally a financial earthquake that flips the math of the entire planet upside down.
Because think about it, when borrowing in yen suddenly costs real money, the free money stops being free, and investors don't politely wind things down and walk out, they absolutely sprint for the exits. August 5th, 2024 was a terrifying dress rehearsal for this. The yen spiked in value, meaning all those 0% loans suddenly cost way more to pay back. Everyone tried to unwind the trade at the exact same time. Japan's Nikkei dropped 12% in a single day, which is worse than 2008, by the way. The S&P 500 tumbled. It was a very dramatic preview of shifting currents.
Now, that panic eventually stabilized, but it triggered a massive reversal that's still happening: repatriation. With Japanese government bonds finally paying a real return, money managers like John don't need to do these crazy financial gymnastics overseas anymore. They can actually earn a decent return at home without taking on any currency risk. The incentives have completely shifted, and Japanese capital is finally coming home.
And this shifting capital creates a truly massive problem for the United States. A lot of people guess China, but no, Japan is actually the single largest foreign holder of American government debt on the planet. For decades, they've been America's best, most reliable customer. They are like the regular at the diner who always orders the exact same thing every single day. But now, that regular is starting to skip meals.
This collision course meets some pretty brutal math here in America. The U.S. is currently running deficits of around $1.75 trillion every single year. The total national debt is sitting at over $37 trillion. And just to add to it, in 2025, Moody's actually stripped America of its last perfect credit score. So the US Treasury has to issue this staggering supply of new debt just to keep the lights on, right at the exact moment our biggest buyers is heading for the door?
So it really just boils down to basic Econ 101. When the supply of debt goes way up and the demand for that debt goes way down, there is literally only one way to convince new buyers to show up. You have to pay them more. Yields absolutely must rise. That is exactly why we are seeing yields on things like the 30-year Treasury sitting up around 5%, which is a level that used to be completely unthinkable just a few years ago. Just to underline how serious this whole dynamic is, consider this thought from Ray Dalio, the founder of the world's largest hedge fund. He points out that the bond market is the backbone of every other market. If supply and demand break, you get long-term interest rates climbing, which can trigger what he vividly calls a debt-death spiral. So this sleepy, supposedly boring bond market story, it's actually the foundation of every single financial asset on Earth.
Okay, so let's connect this big macro story right back to your wallet. I call it the everything story. First up, stocks. When long-term rates rise, the discount rate applied to future profits goes up, which naturally shrinks a company's valuation today. Second, mortgages. These are heavily tied to the 10-year Treasury. If that yield won't fall, neither will your mortgage rate. And third, corporate debt. Companies that borrowed heavily when money was totally free in 2020 and 2021 are hitting a maturity wall right now, and they're being forced to refinance at much higher rates.
Honestly, this completely reframes how we should look at financial media. Compare the loud news, AI bubbles, Oval Office shouting, geopolitical tension, with the quiet reality. The quiet reality is that discount rates are silently moving underneath everything, steadily shrinking stock valuations. That invisible mathematical tide is exactly why the market can suddenly drop on a random Tuesday when there is absolutely no bad news on your television.
And let's bring it back to that prospective home buyer from the beginning, the one white-knuckling a 7% mortgage, desperately waiting for rates to drop back to 3%. She's waiting on Washington. She's watching the Federal Reserve. But actually, scratch that. Her relief isn't coming from Washington at all. Her relief is tied directly to Tokyo. It's decided by an institutional manager like John who just figured he'd keep his pension money at home instead of buying US Treasuries.
And the impact on the business world is just as profound. Think of it this way. Credit is basically the bloodstream of the corporate world, and the long end of the yield curve, that's its blood pressure. When companies hit that maturity wall from the cheap debt era, they have to refinance in a world where borrowing is suddenly incredibly expensive. And what happens then? They pull back, they hire less, they build less. The whole economy feels the squeeze.
Now, I want to be really clear about the timeline here. This is not some overnight doomsday movie plot. The Bank of Japan moves at the speed of a glacier wearing a business suit. They aren't going to dump all their US debt tomorrow morning. What we are looking at is the slow leak versus the dramatic pop. But in a slow leak, the direction is what matters. We are entering a real structural shift to permanently higher borrowing costs over many years.
As all that Japanese capital unpacks its bags and stays home, global liquidity tightens up. Think of liquidity as the oxygen in the markets. You literally don't notice it at all until it's suddenly harder to breathe. And when the system runs short on oxygen, spoiler alert, the hedge funds are usually perfectly fine. The people who actually feel the choke are the everyday consumers, the couple trying to buy a house, or the small business owner whose credit line just got quietly more expensive.
So the ultimate takeaway for you from this explainer is this. The loud risks, the ones screaming from every headline and YouTube thumbnail, are usually already priced into the market. It's the quiet risks, the completely unclickable, boring mechanics like cross-currency carry trades and repatriation that actually take you out. Understanding these invisible forces is absolutely vital for your financial survival.
So, as we wrap up our look into this massive global shift, I want to leave you with one final thought to chew on. If the largest, most reliable buyer of our debt is packing up and heading home, what happens when the global financial system quietly runs out of oxygen? Thank you so much for joining me for this explainer, and remember, keep your eyes on the quiet signals.